Let's take a look at a natural gas company that offers a mouth-watering 9.5% dividend yield. You might almost say it's extraterrestrial, out of this world, because the ticker symbol is ET for Energy Transfer. It has nearly 125,000 miles of pipelines and associated energy infrastructure across 41 states, transporting the oil and gas products that make our everyday lives possible. It's estimated that 30% of US natural gas and oil move through their pipelines. And despite what some clueless protesters think, or the nonsense ESG initiatives that politicians are pushing, oil and gas will always be used until you can provide a better alternative. The US uses more than 860 million gallons of petroleum and petroleum products every single day. This includes almost everything around us, from plastic bottles, hose, sorry, I was supposed to say shoes, but we'll just leave that in there. So this includes everything from plastic bottles, shoes, household cleaning products, clothing, jet fuel, and gas for our cars. The way Energy Transfer makes money is they own and operate an extensive network of pipelines and other infrastructure for transporting natural gas, crude oil, natural gas liquids, NGLs, and refined products. The company charges fees to customers who use their pipelines and other facilities to transport their products from one location to another. These fees are often based on the volume of their product transported or the distance covered. They're also going to be making money from providing storage solutions for the energy for their customers, for the processing plants they own and operate that separate and process raw natural gas. They're entering into long-term contracts with customers, so in a way this is predictable cash flow like we see in a rental property. One big drawback to ET is that they are an MLP. A master limited partnership is a business structure that combines the tax advantages of a limited partnership with the liquidity of publicly traded securities. Unfortunately, this can lead to K-1s being issued and making your taxes that much harder. Some accountants, they charge more money if you have a K-1, so just keep that in mind. Analysts love this company. Out of 6 analyst ratings, 5 have it as a buy and 1 has it as a strong buy, with no sells. Its consensus price target of almost $17 means there's potentially 30% upside left to be unlocked with ET at today's prices. Not only are you getting that giant dividend yield, but you also get a chance at some capital appreciation, the best of both worlds. ET became a public company in 2006 and has paid dividends every single quarter since then, including the 2008 recession and the 2020 C-19 forced shutdowns. It should be noted they did cut their dividend during C-19, but they have already recovered to now paying more than they did prior to the cut. It's also got a pretty high payout ratio. Every site I'm seeing has it over at least 70%, but that's expected of oil and natural gas companies. Established oil and gas companies have stable and predictable cash flows due to their consistent demand for energy products. This stability allows them to confidently commit to paying dividends to shareholders. It's a very capital-intensive sector. It costs a lot of money to put into place. Those exploration and drilling equipment can be really expensive, but once that's done, it really pays off and you, the investor, gets rewarded. Some breaking news is that Energy Transfer has signed a definitive agreement to acquire Crestwood Equity Partners for around $7.1 billion. This acquisition will now give ET even more access to more basins. This is just the latest in a handful of acquisitions the company has done in the past few years. Energy Transfer has nearly tripled its shares outstanding in the past 5 years, going from 1 billion to 3 billion shares outstanding. That's not a good trend, means an existing shareholder's equity is getting diluted. Alright guys, I created a new Google spreadsheet with some formulas to showcase stocks on this channel. I'll make it available to my Patreons, but of course, this is just a rough draft for now. Any other important metrics you want me to add, just let me know. So ET is up 11% for the year. They're trading than their 200-day moving average. In the past year, it's traded anywhere between $10 and $13.70. It has a beta of 1.68, so that means it's actually slightly more volatile than the overall S&P 500. The PE ratio is pretty low. They trade at 11 times its earnings per share. That means investors are willing to pay $11 for every $1 of the company's earnings. In the last 5 years, they have been able to grow their earnings per share by 32%, which suggests the company has been able to experience growth in profitability, and that's a positive sign of financial health and performance. They also, of course, have that super strong dividend yield like we talked about of almost 10%, as well as a high payout ratio like most oil and gas companies. Alright guys, I just wanted to make a quick video about a high yielding dividend stock to put on your radar. If you like dividends, you might like this video right here. Be sure to join the Patreon to see my full 6-figure portfolio I was able to amass in my mid-20s. I also post all my trades every single week. As always, my videos are found in podcast form under the Collect Cash podcast name. And I will buy, stash, and collect cash you later.